Welcome back to the Real Estate Reserve Podcast. I'm Jason Balen from Hard Money Bankers. Ian Horowitz from Equity Warehouse tuning in as well. I've got a great guest lined up here that we're going to introduce in a second. He's been on our podcast before a few years ago, but a lot of this stuff's related to insurance. Let's just say that. And I've got a lot of questions. Ian's got a lot of questions. I think most real estate investors out there, or anyone who's involved in insurance, has a lot of questions. Insurance rates have gone up a lot. There's a lot of areas that it's hard to get insurance in. The insurance markets have changed a lot. So we wanted to do like an emergency episode to bring in Ryan to talk to him about this. So
yeah, this is going to be a good topic. I don't know if I have questions or just more bitching like I usually do. So, and you guys will find out. Ryan is really knowledgeable on this topic, because when you spend a lot of time offshore fishing and you're stuck out there on a boat with the guy, he'll tell you all about insurance, and you learn when you're bitching and you're standing face to face. He's like, well, here's the reason. And you're like, okay, that makes sense. So I'm excited for this episode. And guys, if you get any value out of this, the best compliment we can give Ryan is by sharing the show. We don't care about the likes, the subscribes, any of that crap. It doesn't do anything for us, but we'd love to help our guests out. So please feel free to share the show. And that's the best compliment we can give our guests. So with that being said, I want to introduce Ryan. I had the opportunity to fish with him this year in the White Marlin Open, second year in a row, and we actually went to the scales. So that's equally as exciting. But before we get to all that, we're going to talk about insurance. So let's bring in Ryan and go from there.
Hey guys, Ryan, how you doing? Good. Hey, Ryan, let's just do a quick intro again. For those who didn't watch or listen to the first episode, a little bit about yourself and your company, then we'll dive right in.
Yeah, sure. So my company is Lehigh Partners. So I started the insurance agency going on 13 years ago. Initially just started doing business insurance, working with small businesses primarily, expanded to home and auto. I got involved in real estate and started to kind of network in that area, and then really kind of found our calling working with real estate investors. So our markets are pretty much all tailored towards real estate investors. We look for the most competitive carriers in the space. So probably right now about 60-70% of our book of business is pretty much real estate investors.
So the magic question is, why are insurance rates so high, and what direction is insurance going on real estate?
Yeah, it's funny. No one's ever mentioned that before, that their insurance rates are going up. This is a new one for me. So only every other phone call probably. So there's a couple of things at play which have really caused the insurance market to turn on its head. So really this all kind of started right around COVID. So right around, even a little bit before, we started to see the market turn a little bit. Certainly in a post-COVID world, there's only been, so it's just been more gas in the fire. So primarily the main driver is just inflation. So when you're an insurance carrier, you have your actuarial tables, which say, okay, if we take in this much premium for this line of business, we can expect to pay this out in claims. That's all well and good. The math is pretty solid in a stable market, but when inflation, especially on like building materials, goes way outside of where the carrier estimates, that's when they can kind of get into trouble. So the main driver of insurance costs is really the inflation that we've been seeing really in a post-COVID world. So as carriers estimate, hey, it's going to cost us, $20,000 to repair this kitchen. It's now going to cost us $35,000. They still can't charge that same premium and end up profitable at the end of the year. So unfortunately, property insurance, specifically older investment properties, they've been probably like the redheaded stepchild in the insurance world right now. So a lot of carriers have stopped writing investment properties. They're really cracking down on underwriting as far as not taking older properties, or maybe they want the roof to be within like 10 years of age, et cetera. So the market's a lot shallower than it used to be. So go ahead.
Sorry, I was just going to say, how much effect have some of these natural disasters taken related to, Florida storms that's happened, flooding, wind damage, obviously California wildfires, other areas of North Carolina.
Yep.
Has that taken into effect, or is that stuff just not realized yet because it just hasn't it's recent?
Yeah, so my agency's licensed in 26 states. We never really targeted Florida or California. We would take business there incidentally. Someone had like a second home in Florida or something, and they wanted us to write it, keep everything under the same house. We would be able to have a competitive market. A lot of the national companies would touch Florida. All the ones that play ads in the Super Bowl. Now the market is pretty much dried up down there. The Florida insurance market is really on the verge of collapse. California is probably not much further behind. And it's basically, again, just due to those kind of catastrophic claims. Now, if you do not live in Florida or California, your rates are still being impacted indirectly by those kind of large scale events. And how that happens is basically insurance companies have insurance. So they have what's called reinsurance. So if a carrier, suffers a large natural disaster and they would essentially go insolvent by paying out all the claims, the reinsurance carrier steps in to pay those catastrophic losses. The problem is there's only like 5 reinsurance carriers servicing the entire United States. So all of those 5 reinsurance carriers have been impacted at like a pretty crazy amount, with the exposures down in like Florida, California, the big wildfires and things like that. So when those carriers become unprofitable, they increase their insurance premiums to their customers, and their customers are the insurance carriers. So the back end cost to operate an insurance carrier goes up, just like an administrative cost. And that, again, just gets passed along to the policyholders. So even though directly a fire in California has absolutely nothing to do with Pennsylvania homeowners, you're still going to see an increased premium because of it, because the insurance companies are having to pay those higher reinsurance premiums.
Yeah, no, that definitely makes sense. Is there any theory behind like what happens to the real estate market, to the economy, if insurance companies just refuse to insure properties in like a state of Florida or something? Like what happens, and I'm not asking if you know the answer. It's more of like a theory of, well, does property values plummet because everybody, if you want to buy a property, there's just no insurance? Is there secondary insurance companies that you have to pay a gigantic premium for in order to get, or does everybody have to self-insure and, you just take on the own risk?
Yeah. So, it certainly does have an impact on real estate pricing. So, for instance, in Florida, and this is like the last time I heard this figure was like a year ago, so it's probably changed since then. But about a year ago, the average homeowner's insurance premium in Florida was like $7,500. So we haven't personally seen any, but I've definitely seen and heard about some deals that have gotten blown up just because of insurance costs. So, someone gets something under agreement, they find out it's going to be an astronomical amount to insure, and then they walk away. So certainly like California, you're seeing that, like, those large kind of mega mansions, people are getting insurance quotes, that have, over $100,000 for fire insurance. So, people don't really necessarily want to pay that every year. Year in and year out. So you're definitely starting to see an impact on that higher end of the market. But then also for like any sort of coastal properties too, especially down in Florida, you're really seeing those insurance costs rise. So yeah, it's definitely having an impact on deal flow.
Yeah, dude, I don't know. I mean, it's hard, especially you got that compounding with like cost increases, tax increases, and everything. It's like, where do you cut? What can you cut? Like, as real estate investors, when we start looking into policies, I know you've done very well for us. I mean, I don't normally shout people out, but you have helped us out immensely. And you're actually one of the only insurance brokers that actually ever had someone go and shop our insurance every year and say, hey, there's a better deal. It's a gigantic pain in the ass, but it's worth moving carriers. We as real estate investors, what can we do? And let's just talk about single family specifically. What can we do to reduce our policy costs to combat this, but not give up the real purpose of what insurance is?
Yeah. So a couple of strategies you can employ. And the one is you definitely want to be strategic about claim submissions. If we'll call them like a ding and dent claim. So like if a piece of siding blows off your investment property, it's going to be $1,800 to repair. You have $1,000 deductible. In this market, there's a 0% chance that you'd want to ever submit that as a claim to, go through the whole process, get a check for $800 after your deductible. So we really want to be careful with what we're submitting, because carriers are also looking to come off of habitational business if possible, and they're using those small dollar claims as a reason to non-renew coverage. So we definitely only want to be using insurance for something that's going to have a noticeable impact on your bottom line. Now, everyone that limit's going to be a little bit different. There's definitely going to be people in the market that $800 bill, for that piece of siding that blew off might be financially devastating. There's other people where they could self-insure a $50,000, $100,000 loss and not really notice it. So that's a conversation we'll have on an individual basis, depending on what all the investor has going on. But definitely want to be strategic about claim submission. Kind of in that same vein, we also want to look at deductibles. So one thing you can do to decrease your premium without really effectively compromising your coverage is just bump up your deductibles. $1,000 for years and years and years was the gold standard. Now I would say on the lower end for an investment property, we're looking at usually recommending a $2,500 deductible, on a single family. And if, it's a larger property and it's a more experienced investor with a bigger war chest, we're going to bump it up from there, or recommend they bump it up from there. But certainly being strategic about claim submission and then, looking at your deductibles are two ways, to reduce premium without really compromising your coverage. The third thing is, and you kind of touched on this a little bit, Ian, was if your agency isn't remarketing your policies every year, or you haven't heard from your agent in a number of years, it might be time just to dip your toe in the market, see what else might be out there. We've certainly seen some policies that have just sat with an agency for years. No one ever looked at it. Finally, they do, and it's like, $1,500 more a year than they remembered it being. And we'll remarket something, or another independent agency could remarket something, cut those premiums way down. So those are kind of like the three things that I would recommend.
Have you seen, you mentioned earlier related to, and we can stay on this topic of single family fix and flippers, and how some of these insurance companies are trying to stay away from that business a little bit, maybe a little bit more high risk and things like that. Mm-hmm. Like one thing I've seen, and correct me if I'm wrong, but besides the prices going up, I'm trying to think of what the term is, but the guaranteed earned percentages have been going up. Like, for instance, like let's say it's a 1-year policy and then they have a certain amount of earned. I think in the past I've seen that there's like, it's guaranteed 3 months earned. Even if you pay it off, like, the first month, they're guaranteed 3 months, 6 months, 12 months earned, depending on how it's written. Have you noticed that some of those are longer term, I guess, just so the insurance company is guaranteed to make some money on it?
We'll really only see that on really like hard to place risks, or like a builder's risk type policy.
Yeah, builder's risk. That's what I mean, though.
Yeah. So that really hasn't changed. So that's always kind of been the case, is like you buy a policy, you cancel it tomorrow, you still have 3 months of premium. That's been pretty stable. Unlike the builder's risk side, there are some carriers that I think the lowest that I'm aware of is about like 10% minimum earned. But pretty much the gold standard's like 3 months on something like that. That hasn't really impacted. It hasn't changed at all. That market's actually probably been the most stable with builder's risk. So those carriers pretty much know what they're getting into. And more or less, I think they know it's either going to burn down, it's going to have a fire, be a total loss, or they're not going to pay out a claim. So that market's been pretty stable, more so than like the occupied investment property market.
Is there anything that you see real estate investors, let's say, is there like a tip or trick in essence for a real estate investor to try to get a cheaper premium by removing an endorsement or something, by stating like, hey, there's no point for you to do this. This is low risk to begin with. Yes, normally in the past, you might as well put it in there because it's $50 extra and who cares. But is there ways to kind of trim out that policy just to keep costs down? You see where I'm going with that?
Yeah. So what advice I kind of always give our clients is like, as you scale and your investment business scales, you want to start throttling down and effectively self-insuring some of, the smaller things that can happen. So, like for instance, if it's a single family home, if it's a dirt floor basement, we're never really going to recommend water backup. The coverage limit's usually, 5 to 25,000. It's with a dirt floor basement for remediation of, water that gets in there. You're not really going to look at that. But let's just say it has a finished basement. That water backup coverage is something that we're going to recommend. But certainly as your portfolio grows and, just say it's, $50 per property every time you add it to it, add it to a policy. If you have 50 or 100 units, you really don't need to carry it anymore because you could effectively put that $50 in a savings account. And God forbid, should you have a water backup, you can really pull it right from savings. So certainly as your portfolio grows, we want to actually scale back your insurance. So you take a little bit more of the risk, but then also share a bit in the premium savings as well. So I will look at that again as like a case by case basis. If it's, an individual, it's their first property, maybe they need a little bit more financial protection, downside protection, I guess you could say. But certainly, again, as you scale, you want to start decreasing your coverages.
Yeah, I remember when we switched to you, you're like, hey, man, you're paying for mainline drain coverage. And I was like, yeah, but we've hit it before. And he's like, dude, you got enough properties. You can just effectively save that. Don't do it. Strip it out of the policy. And I think a lot of people like misunderstand, like, you got wind, you got all these other like factors. And like, if you start investing outside your local jurisdiction, like we're all up here in the mid-Atlantic, we're not as worried about wind coverage. And I don't even know what riders we get. I've never asked about it. But then we started buying stuff in the Southeast. That's all everybody talks about is wind and hail, and how crazy it is. So it's an interesting thing that, I think the deeper you get, the more you start to understand your insurance policies. And then the problem is you don't want to tweak stuff out that you screw yourself on later. Right. So, so then, also along those lines, like, starting to strip things out, how do we prevent, and I know we can't prevent, but like, how do we know, like, if you reshop our insurance and we reshopped it this year and you got us a better deal, but then a couple of the carriers we switched into, we had to do a roof, we had to do concrete, we had to do all these dumb requirements. Like, how can real estate investors avoid that? Or is there any way around doing that? Or is that just the nature of the beast?
Yeah, so it's definitely always going to be a balance. Obviously as an investor, we all want to maintain a rate of return. So that's going to be a little bit different for every client. So some clients, maybe they know they've neglected some of the CapEx expenditures, the 30-year roof's 30 years old, and the carrier is going to want to see that updated. Now some carriers inspect, and it's a function of the current marketplace, but some carriers are going to inspect a little bit more tightly than others. So, if it's a roof and it looks okay, maybe X carrier has an issue with it, you can weigh the cost of actually replacing it, updating it, versus maybe moving laterally, paying a little bit more on your monthly premium to, essentially kick the can down the road a little bit, on some of those capital expenditures. But yeah, that's just kind of a balancing act. It's kind of based on the individual carriers that you're looking at. Everyone, again, is going to be a little bit different.
Yeah, well, it's the worst when you get a drop. That's the worst part, because like you're starting to see insurance carriers just pull out of certain markets. And I know we talked about this at length one day out on the boat. We were discussing like, how do you stop them from like just pulling out and being like, you're screwed? Like, I guess when the insurance carriers are looking at that and they're just like, we're done with Baltimore City, or we're done with this location, we're not doing single family houses, and just shut the line of business down. Like, that just seems crazy to me. Like, what's their thought process? I mean, I know you're a broker, but is there any insight on that? Like what they're thinking when they're doing that? Because it's a pain point for all of us, right?
Yeah, no, myself included. I had most of my portfolio non-renewed with Berkshire Hathaway Guard. So Guard discontinued personal lines products, investment properties and personal homeowners in all like 40 plus states that they wrote in. So like what you can do if that happens, nothing really. You're not gonna stop machine that large, have them change course. So what they're doing is basically looking at their book and then their loss experience and saying, okay, like, can we ever get this profitable? Can we get the rate we need to maintain profitability? And if we get there, are people even going to buy it? So Berkshire Hathaway Guard, basically the answer to that, when they asked themselves that question, it was, no, we're not going to get there. So we're just going to pull the ripcord. But that's constantly what we've been dealing with the last couple of years is, carrier driven non-renewals, based on, whatever factor, or they're re-underwriting their book, or like they're just pulling out of the market altogether. So, it's definitely been a pretty dynamic market. I mean, I've certainly never lived through anything like this in my career. And a lot of the older, like more seasoned insurance agents that, I communicate with, right around like COVID, they're like, oh yeah, don't worry. This happens like every like 8 years, 10 years. Like, and then I talk to those same guys now and they're like, yeah, no, this is a little bit different. So, it's just kind of the, you were as agents and as consumers, we're sort of just a cog in the wheel to these, multi-billion-dollar insurance companies. But yeah, all they're really doing is just looking at the financials. And if they don't make sense anymore, they're pulling the ripcord.
Yeah. So I mean, I guess, in some of these areas, they might, even if they're not active on it now, maybe they come back, or they readjust their underwriting. I'm just really always curious about like the state of Florida and places like that. And like, is there any industry knowledge about how many people are uninsured? Like the percentage of people uninsured?
Yeah, I mean, those there's definitely estimates out there offhand. I don't have those figures, but in Florida specifically, so pretty much every state has like an insurer of last resort. Like Pennsylvania, it's the PA Fair Plan. So if you have 19 claims on your homeowners, no carrier wants to write you, you can always go to the Fair Plan. It's an insurer of last resort. But it's designed to house maybe 1-2% of the entire the entire insurance market in the state. Rates are terrible, coverage is terrible, but if you can't get anything else, it's better than nothing for sure. So Florida has something very similar called Citizens. Citizens, again, it was designed for like 1 to 2% of policyholders, if that, to be on that program. And the last figure I got was like 75% of like all homeowners in Florida are currently enrolled with Citizens. So like no one really knows what's going to happen. I mean, there's probably going to be some like governmental, involvement at some point here, with legislation, to kind of try to rectify that, because it's going to collapse. I mean, there are a couple hurricanes away of, just running out of money. So we'll see what happens there. But yeah, Florida's a mess right now. I feel very bad for any independent insurance agency still in operation in Florida, because it's just a mess.
Yeah, and like with the word collapse, I mean, I think that's a good word that I think I would use as well. But like, I don't even know what that even means, collapse in this case. Like, does it reset? Like, what happens to the real estate market? I mean, one big thing is lender requirements. If you can't get insurance, your mortgage company could either call the loan, or you're not going to ever get a loan from anybody else. And then that's a challenge. Like, if the whole state or a big portion of the state or whatever, county, city, neighborhood, there's no financing available because you can't get insurance, what happens to that? Like, to me, stuff resets. And it's like, okay, well, let's, a property worth $1 million, maybe it's only worth, I don't know, $400,000, because you're going to get you got to pay for that $30,000 a year in, high risk insurance policy. I don't know.
Yeah.
These are all.
Yeah. I mean, it throws off like debt to income for a lot of buyers. I mean, we work and partner with a lot of mortgage brokers, property management companies, realtors. And we see that all the time. Like, hey, we need to bump up the deductible a little bit, because we can't get the DTI where we need it to be. So, I mean, that's already having an effect, but yeah, I mean, that's only 10x in like a jurisdiction like Florida, where, you know, insurance is much more challenging of an environment than it is up here.
All right, let me ask one more question that I think is really relevant to a lot of real estate investors, at least in the single family space. So let's say a real estate investor is fixing and flipping a house. They get a builder's risk and liability policy, pretty standard policy. And they put that property on the market, beautifully renovated property, and they overprice it and it doesn't sell and it sits on the market. Is there a certain period of time that they need to call you, their insurance company, and say, hey, listen, and convert that into a different policy, a vacant policy? Or does that normally a builder's risk policy, go out in advance, for a certain period of time?
Yeah, so generally, like a builder's risk policy, you're going to look for to insure it for purchase price plus whatever you're putting in it. So they're typically sold on the shorter side, like a 3-month period policy. Up to a year is probably the longest you're going to see for a single term. Of course, you can renew it. Generally, if it's vacant under renovations and going on the market, you wouldn't really shift that policy. The rates are going to be the same essentially for if you're insuring a vacant building or a builder's risk. Now, the only time that would change is obviously if it goes occupied. We certainly want to transition to an occupied policy, but for something that you buy in January, you renovate it, you're done in April, and you sell it in July, that would remain on a builder's risk policy. We wouldn't rewrite coverage just to like a purely vacant only policy, because again, it's going to be kind of 6 eggs, half dozen.
Got it. Because technically, vacant's probably more expensive than builder's risk, right? Because builder's risk, at least somebody's on site.
No, I mean it's
about the same.
Yeah, I mean, so when you're looking at a builder's risk policy, they're assuming that no one's going to be there aside from the contractors working on during the day. So, like with a builder's risk type policy, again, they're only expecting really effectively to see a full loss, mainly due to fire, or they're not going to pay out any claims. So the issue is, and why they're typically more expensive than like an equivalent occupied policy, is like if you're sitting in your living room and you start smelling smoke, you can quick call 911, maybe extinguish a small fire yourself. On a vacant policy or builder's risk type policy, by the time 911 is getting called, it's because the neighbors are, smelling smoke or they're seeing the flame shoot out of the window. So they're much more likely to be total losses than an occupied property.
I get it. Ian, anything else you want to discuss? Or are you going to be talking about fishing in the latter half of
No,
this?
I'm just watching the cash fly out the goddamn wallet because all I hear is insurance costs is going to continue to rise. But, I guess one day this all levels off, right? If there's stability in the country, I guess there's stability in the insurance rates, there's stability in the market as a whole. And, the work from home, I think, started to balance out, right? Just to give people metrics, and I'm just regurgitating what you said, was like everybody started working from home. There's more cooking fires, right? And then therefore that drives up replacement costs, and then you got inflation, and hopefully this all levels out. And I guess maybe we're almost at that point. But I guess we'll see.
And like it's not all gloom and doom. We're starting to see the beginning of the market kind of soften a little bit. It's kind of just like interest rates. They go up real fast. They take a long time to come back down. So insurance is kind of the same way. They went up pretty fast. It's going to take a while till they come down, but we're starting to see that peak. With most markets, some markets are, still on that gloom and doom path, but, certainly we're starting to see it's starting to come around a little bit. So, short term, I would say next 18, 24 months, there's just still going to be pain. But I think kind of outside of that, we hopefully should start seeing, rates start to actually come down.
Well, that's good news. So boys just got to hold on and we'll be good. And, whatever, I guess it is what it is. So, guys, if you got any value out of this, please make sure you share because it's the best compliment we can give Ryan. Ryan, where's the best place people can find you on the internet and they want to learn more and they want to have their insurance checked out and talk to you?
Yeah, probably our website, lehighpartners.com. So our phone number's on there. There's also send us a message on there as well. So just lehighpartners.com.
All right, we'll get that in the show notes. We appreciate you coming on, and we'll catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.